Hey everybody, Signa here with the Bullish Bears, and in this video we're going to start working on the Greeks, and we're going to go ahead and start with delta. So what is delta? Delta is the rate of change in the options price for a $1 move in the underlying market. That is the generic, look it up in the dictionary, definition of options delta. So what does that mean? Well, when the underlying market, in our case that would be the SPY, when the SPY moves $1, then the delta will be applied to the value of the option. All right. Can we visualize that in some way? Yes, we can. So if we look at the mark on the option, we can see we're going to focus on the 410 strike. The mark for the 410 strike is $3.49. If SPY was to make a $1 move, we would add that 54 cents to $3.49, and our new position would be $4.03. All right, does that make sense? We take 3.49 and we add 54 and we get 403. Get the old calculator out. 3.49 plus, well, what did you say? 54.554, 4.03. So for every $1 move in the underlying market, delta will be applied to the value of the option. But that's not all that we use delta for. Now this is a video that's introducing delta, so I don't want to overwhelm you with too much, and there is a more advanced video on delta later on. In this one, we're just giving a broad outline of these different Greeks. So what else do we use delta for? Well, we use it as a representation of stock. If we're looking at an option chain and we're discussing a specific strike, in this case we're going to focus on the 415 strike. If we're looking at the 415 and it has a delta value of 30, then that tells me that this 415 call represents 30 shares of the underlying market, the SPY. Now at expiration, if this strike ends up in the money, the delta will move up as the stock, or as the strike moves up, and once the strike is in the money, it will have these in the money deltas. But at expiration, all of those that are in the money go to 100. They turn into 100 because at expiration, any options that are in the money turn to stock. All right, so the delta will go to 100 at expiration because that strike that's in the money is now 100 shares of stock. But we're not at expiration. We're 2 days from expiration, and we're out of the money. So right now, if I was to buy that 415 call and I wanted to know what's my risk here, what does this call actually represent? Well, it represents 30 shares of SPY, and that is the accumulated risk that I'm holding right now. If I owned 30 shares of SPY and SPY was to move up or move down $1, then for every share that I own, I'm making or losing $1. I own 30 shares. Now we can figure out exactly how much money I'm going to make or lose in that $1. So delta is not only the rate of change for the options value for a $1 move in the underlying market, delta is also a representation of stock. What else is delta? Well, another thing that delta is a representation of our probabilities. We want to be able to ask a question, and this is how old school traders do this. in later videos, I'll show you the new tools that we use for this. But if I wanted to know what my probability was that this option could even end at expiration in the money, I can look at delta. So for an example, the 417 strike here on SPY on the call side, it right now has a delta value of 22. This is telling me that the 417 strike has a 22% chance of being in the money at expiration, which is 2 days away. Now, that's pretty cool, right? I think that's pretty cool. So what I want to do now is expand how many strikes we're looking at. We're just going to open up quite a bit. And I want you to notice here in the upper portion of the screen where we have delta, that the delta is at 100. Now remember, at expiration, any stock or any option that's in the money goes to 100. All of these right now are in the money. How come all of those are not set to 100? Well, we're not at expiration yet, but the broker has decided, or the formula has indicated, that all of these strikes are almost 100% guaranteed to be in the money at expiration. Now remember, there's no certainties in life, right? But that's a pretty high conviction level, right? So this is showing us we never want to say that something's impossible, so we say it's improbable. It is improbable that these options would end 2 days from now out of the money, which is why if you were to buy these calls, they would be equal to synthetic stock, if you've never heard that phrase before. See, if I buy the 400 strike call with a delta of 89, that's representing 89 shares. And that's a good representation of stock. That would be a good synthetic. But these options that are even deeper in the money with a 100 delta are representing a 100% correlation of stock, right? So synthetic stock, 100%. If you're asking yourself, how does a broker know that? How could it be so certain? Why is it showing 100? Well, remember that there is an expected move for everything. And the expected move right now is $7.09. If you look at the current stock price where we went into the close, SPY closed at 411.34, and then it fell even more than that after hours. And the bid and the ask as we came into the after hours market and into that close was at 410.50 or 410.70. That was the bid and the ask. The last price traded before after hours was 411.34. If we look and subtract $7 from that, and we add $7 to that on each side, right? That would give us our expected move for the next 2 days. So we're talking about Monday at the close and SPY having moved within its expected move. So from at the money, we're going to go $7 in one direction, and then we're going to go $7 in the other direction. So that gets us to 403, and then it also gets us to 417. So that's our expected move between now and Monday at the close. Now the broker took that and then doubled it. Okay, so this is a 1 standard deviation. They took and made it a 2, possibly even a 3 standard deviation, and that's where they got their 100%. Now, can SPY make the move far enough to put these options out of the money? Yes. There is no guarantee, right? It's improbable that SPY would move that far, but it is possible. Okay, there's a big difference between those two words. But delta in this scenario is a representation of our probability that that strike will be in the money or out of the money at expiration. So when you're looking at a delta, you want to compare it to 100 to determine your out of the money likelihood or your in the money likelihood. So we're going to look at these out of the money options, and we'll choose the 420 strike. It has a 13 delta. That tells us that the 420 strike has a 13% chance of closing in the money Monday at the close. I think that provides a lot of information. I think that gives us a little bit of an edge. It also can help you try to determine, if your stop is too close, because you can ask a question like, how likely is it that price could hit my stop? And if you got in, you could just go from at the money and then measure that probability. Okay, so delta is a probability of being in the money. Delta is a representation of the move in the options value for a $1 move in the underlying market. And we have so many other ways that we can use delta. But hopefully this video provided just a nice little introduction to what delta is. And I look forward to seeing you at the next video.